Many people entering the business world imagine a launch day filled with high-end equipment and social media buzz. They gravitate toward businesses that look impressive in photos, like a boutique cafe or fashion label. But the data tells a different story. These highly visible ventures often struggle to survive past the first few years, and even those that do often leave the owner trapped in the same daily operational tasks they were trying to escape. To understand the difference between a business that works and a business that traps you, we have to look at this comparison table. We're weighing the glamour business against what we call the invisible business. The glamour business starts with a massive spike in social buzz, but because the focus is strictly on individual consumer transactions, the owner has to find a new set of customers every single morning. By the third year, the owner is often still managing the daily grind just to stay afloat. The invisible business starts with zero initial buzz. However, by month 36, the focus has shifted entirely to servicing a locked-in client base. This focus on retention over constant acquisition allows for a systematized, predictable cash flow. Predictable wealth is often found where the social prestige is lowest. Optimizing for public excitement and Instagram likes can often undermine the long-term viability of the operation. The metric that truly separates these two paths is the frequency of payment. In a transactional model, you hunt for every dollar individually. In a recurring revenue model, a single successful sale triggers payments that arrive automatically for months or years to come. Boring infrastructure businesses are built for this type of continuity. Like this circular conveyor belt, they provide a service that is repetitive, predictable, and essential for their clients to keep moving. These businesses succeed because they address chronic, unavoidable problems. When a client has an ongoing problem, like the need for clean floors or functional software, they become a captive audience for whoever provides the solution. Entering this world requires a specific trade-off. You have to be willing to trade social validation for the high probability of long-term predictability. This shift doesn't make the work easy, it simply changes the nature of the work. You stop chasing the next sale and start managing the contracts and systems that keep the revenue flowing. We evaluate models on a quadrant chart, measuring upfront effort against revenue predictability. Tier 1, B2B contract services, like cleaning, sits in high effort, high predictability. It requires heavy input, outbound sales, and workforce management. The outcome? Multi-year contracts providing guaranteed baseline revenue. Institutional clients pay for these services to remove operational friction from their daily schedules. By taking over the liability and oversight of these tasks, you solve a recurring problem they cannot ignore. However, this tier has clear downsides. It offers no social prestige and requires dealing with the high turnover and management challenges inherent in a labor-heavy business. In Tier 1, you are essentially trading the uncertainty of consumer marketing for the daily challenge of managing a human workforce and maintaining quality control. Tier 2 focuses on asset and location monetization. This includes everything from vending machines and water ATMs to heavy equipment rentals for construction sites. Back on our chart, Tier 2 sits higher in upfront friction, usually capital, but offers similar predictability. The input is high capex and rigorous location scouting. The outcome is automated daily cash flow, or rental income, requiring almost no active sales. The primary risk here is the location itself. A high-quality machine in a low-traffic or poorly researched area will result in a financial loss. The success of the model is tied entirely to the geography. With Tier 2, you avoid the labor management issues of Tier 1, but you take on risks related to equipment maintenance and the possibility of a location becoming less profitable over time. This model decouples your income from your personal time, but it attaches it permanently to the physical location and the reliability of your mechanical assets. Tier 3 is micro SaaS. This involves building small-scale software to solve specific operational problems for other businesses, like clinic scheduling or inventory management. Micro SaaS maxes out both upfront time friction and long-term predictability. The input requires deep technical expertise and months of isolated development before seeing a customer. However, the outcome is infinite scalability. Adding subscribers costs nothing, creating the highest possible profit margins. The major hurdle is finding product-market fit. If you spend months building a tool that doesn't solve a critical problem, the entire initial time investment is lost. Success in Tier 3 comes from ignoring consumer trends and focusing on boring tools. If you automate a task that currently takes a business an hour every day, they are likely to pay a monthly fee for that efficiency. Tier 3 allows for significant digital leverage. You trade months of upfront technical work for a business model where profits aren't tied to physical overhead or manual labor. Beyond these 3 tiers, you need a way to evaluate any new business opportunity you come across. Instead of just looking at the potential profit, you should ask how many times that profit will repeat without you having to make a second sale. You can use this 30-second viability filter to screen any business idea through 3 mandatory checkpoints. First, is the problem you're solving chronic and unavoidable? Recurring revenue requires a problem that doesn't just go away after one fix. Second, is the payment structure designed to be recurring? You are looking for monthly contracts, subscriptions, or consistent repeated service needs. Third, is this a critical pain point for other businesses? B2B clients are often more willing to pay for solutions that save them time or reduce operational headaches. If an idea passes all 3 checkpoints, the long-term stability of the revenue justifies the difficult work required to build the system, regardless of how unexciting the service might seem to others. This filter only works if it matches your current resources. You must consider whether you have more capital to invest or more time to spend. If you have capital but very little time, focus on Tier 2. The upfront cost of purchasing machines or locations is your primary lever for creating automated income. If you are starting with high energy but low cash, Tier 1 is the most accessible path. You can use your own labor to secure the initial contracts and then reinvest the revenue to hire help. If you have technical skills, focus on Tier 3 to build digital tools for boring industries that have been overlooked by more trendy software developers. Long-term wealth is built by creating reliable systems. Like this industrial gear, effective businesses aren't flashy, they just work consistently. If you want an exciting life, build a boring business to fund it.